I always warn about trying to too closely correlate dollar and gold movement. A lot of traders still think there's a 180-degree inverse correlation that needs to just move in tandem or inverse tandem.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm your host, Kerry Lutz. Well, markets have definitely been volatile lately, but they've been heading higher, especially the stock markets, the dollar, etc. Where are they heading? Where is gold going? Our good friend Eric Hadik is with us now. And Eric, it's great to have you back on. You find Eric at inside, INSIIDE, track.com. And if you got a question for Eric, shoot me an email, kl@kerrylutz.com. So when last we spoke, Eric, you were talking about an intermediate high for gold, and a lot has passed since then. First, let's start out talking about the dollar.
Well, the dollar, I think, has been in a broad congestion range down near its lows, and I'm talking on a 3 to 6 month basis. We saw the dollar reach some major upside price targets last year. In fact, broadening out that perspective or that outlook for a minute, the dollar since 2008 has been in a slow, steady uptrend. It's at its lowest low basis the dollar index in 2008. Saw 2 waves up during that time. And then as we came into 2018, 2019, it was ready for a final 5th wave rally, which took hold. And the upside price targets that I had published were right around 110 to 113 on the dollar index. We hit that last year. So from a price perspective, we are probably in the process of setting a major top in the dollar index. After a 14-year uptrend, I think that's going to have ramifications on a lot of other markets down the road a little bit. But for right now, dollar came into this year, set an initial bottom, and has been trying to rebound from that. But one of the things I've kept telling my readers is that in order to confirm anything more than just a couple month bottom, the dollar needs to give a weekly close above its early January peak. That has implications on an intra-year trend indicator that I use. And really, it should close above its early March peak as well, which was set near the same level, so right around 105. Until then, it is still languishing. It still has the threat of heading back towards its lows on a short-term basis. A week and a half ago, I explained why a lot of indicators were starting to group around 101.50, 101.60 in the September dollar index futures. That's where I'm looking for it to drop to in the short term. And following that's going to really have a decisive impact on what the dollar does for the next 3 to 6 months.
All right. So you think that's an intermediate low, or is that a whole shift in the trend?
I think that the dollar has set a 3 to 6 month bottom. That low could even hold longer than that, and that we're in a trading range that's probably going to stretch out for some time. Again, having fulfilled 5 to 10 year upside price targets, there's a very good chance that a major peak is intact in the dollar index. That doesn't remove or preclude a retest of those highs. There's other indicators that I use to signal whether or not that's a possibility. But any additional upside potential appears very limited based on those price objectives. And from a timing perspective, I've been talking about 2023 as being a major turning point for the dollar. So I think we're in the very early stages of that transition. And in a lot of trend reversals, you'll see what we have seen in the dollar the last year. And that is you get an initial somewhat sharp sell-off. And a lot of that is a reaction to the blow-off rally that was seen leading into a top. But then a market will trace out a very lengthy, volatile trading range, kind of a B wave or a wave 2 after the initial sell-off. That often consumes more time than even most expect, because it's going through this battle between the bulls and the bears, and I think that's where we're at. So I think it's going to be a trading range for some time, perhaps throughout the remainder of 2023. But as that's happening, you get some of your broader indicators that are more lagging indicators. They're rolling over and starting to head down. And it's that sequence that really sets the market up for a bigger decline, which is what I'd look for out into next year. In fact, a couple of months ago, in my monthly newsletter, Inside Track, I was even discussing when I expect multi-year cycle lows in the dollar looking forward. But in between now and then, I think you're going to see trading range, have those indicators slowly roll over, and then the dollar will be ready for a more significant sell-off out in 2024, 2025.
All right. So then if we're talking about the dollar, obviously that's intimately tied in with interest rates, right? A lot of that's going to dictate where the dollar goes. What are you seeing there?
I still am very impressed by the consistency and the just the accuracy of this 4-year cycle that you've seen in bonds and in interest rates. And in July 2020, I explained why I thought we'd see a major multi-year peak in bonds, low in interest rates. And that was 4 years from the July 2016 peak, which was 4 years from the July 2012 peak. And this 4-year cycle and a complete cycle progression, by my definition, has unfolded since the 1990s. And so after seeing that major peak in bonds in July 2020, which again is a corresponding low in interest rates, there were two things that I looked for looking forward from that. One was the more distant vantage point or target point, and that was for the next phase of that 4-year cycle to time a subsequent lower high in bonds out around the third quarter of 2024, so 4 years from that 2020 peak. In between those two peaks, declining peaks, like I said, you expect normally a market to decline for roughly 2/3 of that cycle, so 2/3 of a 4-year cycle. And there's multiple reasons for that, but a very simple kind of mathematical proportional reason has to do with how markets retrace, and that if you see a decline for 2/3 of a cycle, it allows enough time for a rebound for the final third of that cycle, which from a timing perspective is a 50% rebound in time. So in the case of bonds, I was looking for bonds to sell off for roughly 32 months, which is 2/3 of a 48-month or 4-year cycle, and then rebound for about 16 months. There's a lot of other things. That's the real general broad stroke expectation. Then I look at many other timing indicators to show where that might be off, it might be wrong, or to validate it, reinforce it, and corroborate it, and give me more credibility or more confidence in the credibility of that scenario. Bonds did adhere to that, and they had a sell-off for the 32 months. That time frame came in at March of this year. And I think that the March lows will continue to hold in bonds, and that the next important high, a subsequent low in interest rates, will come into play out in third quarter of 2024. Similar to what we're just talking about the dollar, that doesn't mean that you suddenly get a big rally in bonds or a big drop in interest rates. If anything, we should see a basing process through most of this year. And then into first quarter, second quarter of next year, the chance for rates to drop a bit, or at least the perception of rates, because that's what really drives bonds, and see bonds rebound into that July or August of 2024. Then looking out, you've got the potential for more interest rate hikes, but that's going out a year or two, even farther. Right now, I think that bonds are in a basing period. Interest rates are peaking. We're right on the threshold of the Fed announcement. The general consensus is that they will pause rate hikes today, but that they could very well make sure there's a few hawkish comments in there after the release, letting everyone know that there still is the chance for a future rate hike, perhaps in late July at the next meeting. But the markets respond differently to that than just topping and bottoming in lockstep with those interest rates moves. There's a lot more going on, and that fits with this basing period. Even if there is another rate hike out in late July, that's what you see during this phase of a trend. And I think as we get later into this year, you're going to continue to see inflationary numbers tail off a bit. You may see some economic numbers start to show a little bit of weakness. Even things like real estate and housing, you may start to see that start to come down a bit, all contributing to the Fed being able to stop the rate hike cycle and start to moderate interest rates.
Okay, so down the road, is this pre-election cycling type things? Is that how this works?
That certainly also fits into that. If interest rates are a little more favorable in second quarter, third quarter of next year, that is certainly a series or a sequence that goes along with that 4-year cycle in interest rates. So that wouldn't be surprising to see that have an influence in there either, even though we know, the Fed is completely apolitical and, objective and unbiased.
Everyone knows that.
But yes, so...
All right. So question, gold, silver. We saw all-time nominal high in gold. We still haven't seen much in silver. It's still trading more than 50% below its peak. What's up with that?
I always warn about trying to too closely correlate dollar and gold movement. A lot of traders still think there's a 180-degree inverse correlation that needs to just move in tandem or inverse tandem. But a lot of times you will see, you go back a year ago and you see the dollar and gold moving in sync when you've got things like the Ukraine invasion and other geopolitical factors. With that said, I do think that my outlook for the dollar, even the outlook for interest rates, is consistent with my outlook for gold over the coming years. And in the short term, coming into this year, there were a couple of key time frames and key cycles that I was looking for in gold. One, as you mentioned from our last conversation, was I expected an intermediate peak in silver in late January or early January, and gold in early February. Then after they saw some solid sell-offs into late March, early April, my outlook was for, into late February, early March, I think it was. My outlook was for the next intermediate peak that would probably hold for a few months to take place in the very early part of May. There was a lot of intermediate cycles coming into play just in the first few days of May. And gold and silver rallied right into that time frame, peaked in perfect lockstep with those cycles. And while peaking, that high reinforced my outlook going out farther into this year. And one of the important things, more significant cycles I anticipate in gold and silver is in late October, early November, when I think we'll see a pretty significant peak in gold and silver. And often you get the majority of an up move coming in the weeks prior to that. That doesn't mean that I expect an uptrend from right now until early November. Very often the uptrend only consumes a few weeks out of that entire time frame. And in fact, I actually think there is some, on an intermediate basis, some lower lows to be had before gold and silver finish their correction from the early May peak. And there's a lot of timing indicators that are starting to hone that outlook and pinpoint when the next 3 to 6 month low, the next best buying opportunity in gold and silver is lining up. And that's a time when I would expect the market to start focusing on that late 2023 timeframe in late October, early November, start a multi-month uptrend. But as I said, a lot of times you get the biggest moves leading into those peaks. And so I'll also be watching how the geopolitical landscape is shaping up in the late third quarter, early fourth quarter of this year, and a lot of other factors to corroborate that outlook.
All right. So overall, we're looking higher, though?
I think we will definitely exceed the early May highs by early November. To what extent, that's going to be more determined by how deep the current correction goes. I've got some expectations for that, and if they hold true, then yes, I would expect higher highs. Mm-hmm. But again, that's not a straight up thing, and it could be a drawn out sideways market with a spike high there. That's a lot of that is a kind of a dynamic, fluid situation where the action over the next few weeks is going to help clarify what to expect over the next few months and so forth. But they're the key turning point timeframes that I'm looking at, and a couple of indicators that could be clear by late June are going to really help me hone that outlook for the third and fourth quarter of this year.
Okay. Now let's switch gears, look at oil. Right now it's trading right around $70. It looks like it's weak, could go lower. What are you seeing there?
Oil, I think, has the potential for a third quarter rally. I agree with you. It certainly is weak right now, but the one thing I was watching was the way in which the March and May lows were set in crude. It at least gave the potential for a 3 to 6 month bottom to take hold. But there's a weekly trend indicator that I use that has to turn up if there's going to be any chance of that being a 3 to 6 month bottom. And that would, at the very least, I would need to see crude get back above 75 in the short term, and get a weekly close above that in the front contract month. But there's more than that needs to happen in order to confirm the March and May lows as a 3 to 6 month bottom. There are some intriguing cycles coming into play out in the third quarter, late third quarter, that anticipate a decisive peak in crude and the energy complex. So obviously you'd need to see a rally into that time frame for it to be able to be a cycle peak, a cycle high. And that would certainly dovetail with the recent lows holding, but it doesn't, by itself, that doesn't eliminate the possibility of additional lows before it turns back up. So right now, it too is in a drawn out congestion phase, but I do think that if we can see a little more constructive action over the next couple of weeks, and crude to turn a couple of 1 to 2 weeks, 2 to 4 week indicators positive, then I would start to get a little more confidence in those recent lows holding for some time, and the onset of a new 1 to 2 month, 2 to 3 month rally in the energy complex.
All right. Sounds reasonable. What else should we be looking at? Any other markets that you're following that would make sense for us to keep a closer eye on?
That's a lot of it. I'm also watching, just in the crypto arena, that Bitcoin has some cycles that are certainly have my attention coming into play in mid to late July, when ideally they would set a higher high than what we saw in mid-April. But if that's going to be the case, Bitcoin really needs to hold at or above the 25,000 level. But if it does that and rallies into that mid-July timeframe, that could be a pretty significant peak in the crypto arena.
All right, but if it breaks 25,000, all bets are off?
Yeah, if it breaks, then from a cyclic perspective, I would still expect an intermediate high in mid to late July. But what it would be showing is that it's very likely to be a lower high, and it would still be after that time frame when you would enter another bearish period.
Okay. All right, I'm agreeing with you there. Anything else? Food or wheat? Anything we should really be paying attention to?
Well, I'm still somewhat bearish on the grains, thinking that they've got another leg down in soybeans and corn in particular. But by the same token, there are some pretty major cycles, multi-year cycles, showing that we could see decisive bottoms in the third quarter of this year, ideally in the July-August timeframe. So I think they've got another leg down, but we could start another bull market after the next low is set, again, ideally in that July-August timeframe.
All right, here, got a question for you. I'm not sure if you follow lumber or not, but I like it as an indicator of housing, as a possible predictor. You got any info on that?
I only watch lumber very kind of passively, look at, kind of like you were saying there. I use it as an indicator and look at it from time to time, but I really haven't spent much time on it lately, so I wouldn't feel comfortable giving a strong opinion on it.
Yeah, probably interest rates more or less tell you everything you need to know about housing. in the long run anyway, although the advent of the cash buyer, the expansion, has definitely changed things. But based on what you're saying with interest rates probably peaking, it's probably a net positive for housing, isn't it?
That's kind of hard to say because it depends on the chicken or the egg syndrome. It could be that housing, which really had such a, I guess you wouldn't call it a bubble, but such a parabolic move over the last couple of years, it's got the headwinds now of high interest rates. Even if interest rates pull back a little bit, they are still a significant burden on people looking at buying new houses. You've got supply that was, they've been struggling so much to keep up with, and you see a lot of things on the horizon as far as supply increasing. And so it could be that housing is coming down, and that's what drives interest rates to drop. Just again, it's in every case, and I talk about this. I have an axiom in my trading manual that deals with correlations between individual markets, between factors like this, and it can be very deceptive to look at one thing and think there is a 100% consistent correlation between that and the other, because the first thing you need to know is which one is leading the other. Often they move in coincidence, like the old phrase, coincidence does not necessarily mean causality.
Causality, yeah.
And so if interest rates are going to drop early next year, maybe even late this year, like I'm expecting, that doesn't necessarily mean that all of a sudden housing goes up. It may be that the interest rates are dropping in reaction to housing coming down. So you have to look at each individually and then start to kind of see if there's a higher confidence correlation at work there.
Right. Yeah, well, I'm looking at the housing ETF, HOMZ, HOMZ, and it looks like it's triple topping for the year. We had a top August of 22, August 16th. We got a higher peak in February 2nd of 23, and now looks like it might have peaked a little bit lower June 13th, which was yesterday, actually. So it's not, it's really a indecipherable kind of chart here, looking at, because it had, up until yesterday, it had definitely had higher lows. So, but if it goes to a lower high, what do we make of this?
Well, it'd be kind of like I was just saying that there continues to be some headwinds against housing, and that it still has some correction to do from that big move up that you saw in 2021, 2022. So even if it's just a matter of coming back to a little bit more of an equilibrium point, and even if that's a rising equilibrium point, like a rising moving average, if a market gets too far away from it, too high above it, it ultimately comes back towards it. And even though that's might be reaffirming a long-term positive trend, in the meantime, while the market's coming from that overblown peak back to the median or the equilibrium point, there's some pain that's felt during that time. And so that's kind of what I'm expecting in housing, that there is just some correction that still needs to flesh out from what we saw over the last couple of years.
All right. Well, I think you've given us a really good overview of the markets, where they're heading. Just tell us, Eric, best place to find you these days.
It is at our main website, insidetracktrading.com. That's with the extra I in the middle of inside. So it's INSIIDE, tracktrading.com.
All right. And there's a link to it in the show notes to this interview on financialsurvivalnetwork.com. And hey, go there. You can just click that link and get right to Eric's site, sign up. And while you're there, sign up for a free newsletter. Eric, always a pleasure. By the way, if you got a question for Eric, which I'm sure you do, shoot me an email, kl@kerrylutz.com. We'll get you an answer. Eric, always a pleasure. Thanks for coming on.
Thanks for having me back, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.